Abdullah, thanks for doing this. Like, this is hopefully the first of many conversations we can have like this. And I think we're also hoping to like have recurring people we can talk about like more topics. But we wanted to have like just very casual chat, record it, see if it's useful to people kind of in the ecosystem, and then go from there. But I think maybe just to kind of kick off, for people who don't know you, I think it's very much worth kind of giving a little bit of background on yourself, both professionally and personally, like where do you grow up, how do you get into law, etc. So, all yours.
Sure. So I try and keep this reasonably succinct. I grew up in the UK. My parents are from Jordan, Palestine, Jordan. But I grew up there from the age of 2 and was educated there. Went to university in London, studied law, qualified as a lawyer in London, working in corporate law.
Why law specifically? Why did you?
So my dad was my inspiration to get into law. He told me a story involving Middle East history and a UN resolution where the absence of one word from the Arabic translation made a big difference on.
Okay.
And I remember as a 14-year-old being extremely struck by how something so fundamentally impactful on the lives of so many people could be impacted by language and legality.
Okay.
So I decided at that age that I wanted to be a lawyer. I also used to, as a kid, whenever there would be like a courtroom drama on TV, I would get completely absorbed into it and was very absorbed by the advocacy aspects of law. And so actually what drew me into law was knowing from quite an early age that I had a very strong attraction to being an advocate of some description.
Yeah.
Like, becoming an expert in some topic and being the person who kind of presents and explains that topic in a way that makes people either understand it better or change their mind. So that was really, it was an inspiration thing at the age of 14.
You didn't go down the like barrister role, like the adversarial courtroom.
I wanted to.
Yeah.
I wanted to actually. I wanted to be a barrister initially, but it was very difficult to get a pupillage, which is like the barrister training contract.
In the UK, you go to like an inn, right? It's the Inns of Court.
Exactly.
Or something.
So getting a membership to one of the inns is doable.
Tricky. Yeah, okay.
But getting a pupillage with like the best chambers, particularly for kind of commercial advocacy, is quite difficult. If I wanted to be a criminal lawyer, I could have done. And in my first and second and third internships, I actually worked with criminal law firms.
Okay.
And really enjoyed, crime as a kind of legal topic. But it just wasn't what I knew that's not what I wanted to do long term. And it's a difficult world to be in because, you're either prosecuting and the moral pressure of being right is something that, weighed on me as an idea, or you're defending and then the moral pressure of making sure that you get the right result is. So for me, it was always going to be about, commercial, corporate, commerce and business.
And if I remember, unless I got this wrong, in the UK, you could be either. So at the same time, so you could be like a barrister, and you could either be acting for defense, and then in your next case, you're the prosecutor,
100%,
representing the crown
100%.
Or the prosecution, right?
Exactly. So the advocate, the barrister, is like a mercenary.
Yeah.
Whoever is paying them
doesn't matter,
is
right?
Who you fight for.
Doesn't matter.
I mean, people obviously develop a name and being a really strong prosecutor in murder cases or being a strong defender in whatever. Anyway, so the criminal law wasn't really what was going to be my long-term goal. I always knew that. There was a possibility of getting into politics. I actually kind of had early aspirations of running for the British Parliament.
Okay.
Having been born and raised there, I was very taken by that whole system that they have. And, but when you're young, you're also a little bit naive and you don't realize quite how much of a game it is. I mean, there's a lot of advocacy, which makes it very attractive.
Are you still like into it, like British politics, or not so much?
I'm into politics generally, and I'm still very much into British politics. But, the way politics has gone in the last 20 years for me makes it now certainly a completely unattractive place to be.
To be in, but to watch from a distance is quite interesting.
Yeah, I mean, even to watch from a distance, there's this, in the old days, when I was younger, sound like an old man, but when I was younger, politics was about there being 2 or 3 or 4 very different viewpoints and approaches to the world. Now it's all just merged into one.
Yeah.
Everybody sounds the same. Everybody wants the same thing.
Yeah.
Everybody has the same ideas, and they're very vacuous, and
Yeah.
nobody's really grasping the serious issues. Nobody takes the big issues seriously enough. So
Yeah, I think especially like I feel the same way about like British politics, in the sense that, you know, like British parliamentary democracy is very unique in its adversarial nature. So back to that kind of advocacy point, and it's very humbling, I think, to all the participants, because everyone gets dragged down in the middle of it. Yeah, I follow it a lot. Like, I'm a big fan. I watch like I like the kind of like the level of dispute, but I agree with you. Like, it's all just merged into this kind of like centrism, and it's
absolutely.
But it's a centrism with no substance, almost. Like, it's just like let's push the status quo over and over and over again, whether it's the Tories or Labour or whoever. Which party would you have been when you were young?
So if you grew up in the UK, that's a question that you generally don't ask.
Yeah, I know. Yeah. But I'll tell you why I'm asking in a second. But yeah.
So look, I mean, I definitely lean heavily towards social justice. So that puts me more in a sort of left-leaning way. But I'm not anti-free market at all. So I wouldn't describe myself as like a socialist. But I do think that from a sort of philosophical and economic perspective, the Marxist lens of politics is probably the one that it always produces the right answers. When I say Marxist, I don't mean, Marxist, Leninist, socialist politics and economics. I mean the view of the world. What shapes the world? What shapes people's agendas? What makes people in democracies vote the way they vote? What do they care about? But that's been turned on its head. I mean, since Trump and Brexit and Cambridge Analytica and social media, I think the world has been turned completely upside down. And so the answers that you used to be able to find logically pre those years have kind of gone.
Yeah, well, there's like my wife's English. I spent a lot of time in the UK growing up. A lot of my family is English, but my wife's family is from Manchester. So every Christmas, I wear the same Margaret Thatcher Christmas sweater, and I always feel I'm going to get stabbed somewhere in Manchester, because she's, as you know, like not very popular there. But I'm of the total opposite persuasion. Like, I identify a lot with like the Tory tradition in a big way.
Well, I do too. I mean, the Tories have a lot of things that they do in a much, much better way than the left agenda in the UK. I mean, on foreign policy, for example, I have a strong preference for the Conservatives, and always have since a young age. So you pick and choose you pick and choose the ideas that you're drawn to in the English or British legal system, British political system. That doesn't necessarily bring you down very firmly on one side or another.
Yeah, absolutely. Anyway, I think like just we'll do a like separate chat on that. I think in of itself, because we can go, I think, very deep into that. But I think just on like what we're on today. So you were lawyer starting to practice in the UK, and then what got you to the Middle East and then into venture specifically? Yeah.
So look, I moved to the Middle East in 2000, and the Gulf region looked very, very different back then. I was based in Bahrain, working with one of the top global law firms, and principally working on project finance transactions with like very, very large financing of utilities and oil and gas projects and industrial projects, mainly in Saudi Arabia, some here in the UAE. The UAE was a completely different country even back, in 2000. And then I got an opportunity to work on a telecom project. And it was in the period around 2003, 2004, when the Middle East governments were beginning to think about liberalizing the telecom sector in the way that the Americans had done and the Europeans had done. And liberalization is a great thing because, it enables a country to, invite companies to come and compete with their state-owned monopolies, which should drive, better quality of service, better prices for customers, but also to raise revenue from selling licenses and getting, the kind of investment and development. So when I worked on the first telecom project, I was absolutely drawn and sucked into it. I loved the industry. I loved what the industry was doing. And I loved the fact that our governments across the Middle East were thinking in this way, competition and the free market. Very Thatcherite, actually, so back on the politics. And the other thing I loved about telecoms in particular was that it was bringing, good quality telecom services. And back in those days, the very early days of high-speed internet, not just the high-speed internet that you can send through a copper wire that's buried under the ground, which was the domain very much of the state-owned telecom companies globally, but now the mobile companies who didn't need to dig up 16,000 kilometers of road to lay cable could actually do internet just by putting towers. And so the technology of telecom really appealed to me. The social and economic impact of technology really appealed to me. And again, back to the politics, for a person who sort of leans towards social justice, I love the idea that telecom brought democratization of access to information, access to markets. So it felt like I was able to be a corporate lawyer who was really participating in an industry that was doing a lot of good for people as a whole. And then the telecom companies, I ended up representing all the major telcos in the region and some of the biggest telcos from outside the region, like Vodafone and AT&T and France Telecom, Orange, on telecom transactions. And the deals that I worked on spanned like 33 countries, tens of billions of dollars of investment, super interesting deals. And then in 2009, when the global financial crisis started, there was no money to do like $5 billion and $7 billion deals. For example, Zain Group bought a license in Saudi Arabia to do a third mobile operator. They paid $7 billion just for the license, without then the billions of dollars they had to put into building infrastructure. So the money dried up in 2009, but what some of these telcos started doing was, in my view, really smart thinking, was how do I kind of integrate technology into my value chain for the purposes of, bringing vertical integration, for want of a better expression, into the telecom value chain.
Because there was a worry, I think, for a lot of the big telcos at the time, just to become like what they call like a dumb pipe. It just the infrastructure with nothing on top of it.
Yeah.
And I think there was a big move towards that. But
100%.
But there was a lot of mixed results, right? They were never really got into the full value chain.
Yeah, well, some did better than others. None of them managed to, but I can't think of a telecom company anywhere in the world that really managed to do what, one of our regional telcos is doing today. I know we're not naming names in this conversation, but there's a big telco in the region that has decided to become a technology company, for example, and I think they're doing, a pretty amazing job in going in that direction. But that's the direction of travel for telcos now.
Yeah.
But back then, telcos made their money from revenues generated from voice, i.e. phone calls, and the profits that you made from international voice were much higher than the profits you made from domestic voice. So the kind of hierarchy of profitability came, from national voice being at the bottom, international voice being at the top, and then data was really where the money was to be made.
Premium tariff, right? Like on a megabyte or whatever.
And then data, we think of data and telecoms as B2C, as how much data do I have?
Yeah.
But actually, the real users of data, even from mobile companies, are institutions and banks and and businesses. So that was what became the game. So a lot of these guys started thinking about adjacent and synergistic technology, and so my practice as a legal practice started slowly evolving more towards kind of private equity type technology investment deals.
I see. Okay.
And then in 2016, one of my long-term collaborators on telecom M&A, he and I founded this small investor group for angel investors that very quickly turned into a fund. And we got a lot of our friends from the telecom industry to come and join us.
This is Dubai Angel Investors.
This is Dubai Angel Investors. And so we started investing in definitely in early stage tech companies. And so being the only lawyer in this network of people, I represented the fund on our early investments. And I loved, the way in which venture deals are structured. I mean, venture deals are complex and they're challenging. and yet they're quite low value.
Yeah.
And so the challenge is,
The ticket is low value, and then the actual, like on the legal side, the fees are low value. So,
absolutely,
but high volume. You can have like a lot of volume.
Absolutely, and exactly. So venture capitalists, they don't spend a lot of money on legal fees. But the way I looked at it was, look, if you work, whether you work on the investor side or the company side in a venture deal, you are ultimately, if you're adding real value, I mean real value, you're going to end up being part of a journey that ends up in an IPO or a multi-billion-dollar trade sale. And you're doing something, that's exciting in terms of the intellectual challenge of the legal piece, but you're working with people who are doing something exciting in terms of disruption and innovation and tech. So for all of those reasons, I've always been very drawn to that. And the Dubai Angel experience helped me a lot in terms of the legal practice, because it immersed me in the industry and it immersed me in relationships with VCs.
Well, I mean, legal and also on the commercial side, because you were running these deals, not just purely from a legal side, but you were kind of talking to founders, looking at business models. And so how many did DAI do, Dubai Angels?
So we invested in 37 companies, of which about a quarter in the US and a quarter in Europe, and the rest in MENA. And in MENA, predominantly the UAE and Egypt, but with a few in Lebanon. We exited all of our Lebanese investments for one reason or another, but thankfully we got out of them. And of the 37 companies, so we exited 4, 2 or 3 have failed, but the vast majority are still operating. And there's a nice little cohort of them that are now post-Series B, and they're doing well. So it's been a great journey.
And so that got you into that got you exposure into VC, and you got the bug, as it were, and you started getting really interested in it, and you built a practice around it, right?
Absolutely, So doing DAI, investing as angel investors, investing as a micro VC, but with angels being the investors, we were co-investing with everyone doing venture in the region. And so, people like you and the other kind of fund managers, there weren't many fund managers in 2016.
But this was ahead of its time, DAI as well. And having a legal practice focused on venture at that time, or developing it at that time, was way ahead of its time. It was, the shape of things to come. And so it was very early. Yeah,
look, I mean, I'm very proud of that. And I'm very proud of the fact that in 2004, when I started doing telecom, it was the beginning of a wave that hadn't yet started, but I knew it was coming. I don't know, I've always had a little bit of a knack for kind of seeing a little bit what's on the horizon, or hopefully seeing what's on the horizon, but it's proven right a few times. So with venture it was the same. And the thing is with legal services, you're selling legal services to strangers is quite challenging. Selling legal services to people who know you and who have seen your qualities is actually much easier. And so it was a natural thing to do that in the legal practice, was to move into that area.
And I think since 2016, there's been a real kind of sea change in venture activity and startup activity and in this kind of whole ecosystem. I think if I remember 2016, I mean, there's, probably under a couple of hundred companies across the Middle East. You could invest in investable companies, maybe 100, 200 a year. Probably deployed capital was minuscule, under $100 million a year, $100, $200 million a year also. And now we're at $3-4 billion a year. So there's kind of been this, Cambrian explosion of activity between founders coming out of companies like Kareem or other companies like Jazz have succeeded, and fund managers emerging, and so it's an interesting time, but not without its challenges. So now, globally, the funding environment's shifted. The availability of capital globally has kind of contracted, particularly probably late stage. So, you're in a unique vantage point where, because of what you do day to day as a legal advisor, you're seeing the ecosystem from a as a third party, from a different vantage point. What are you seeing? What's changing? What's emerged? How do you feel about is there a contraction in our part of the world, and how is it emerging? I mean, the numbers are contracting, but what are you seeing and what are you feeling?
So look, I mean, there's a lot to unpack in that question, because there are multiple angles to look at this from. I think there are global trends that the Middle East is completely in sync with, which is the sort of retrenchment a little bit on the part of people who are deploying capital, particularly in the private capital space, whether you're talking about institutional investors, private institutional or family offices.
Right.
Of course, one thing that we have in the Middle East that you don't have as much of elsewhere is sovereign wealth, meaning, sovereign capital that is finding its way in one way or another into this ecosystem. So, what am I seeing? I'm seeing so many things. So in terms of deal trends, what's happening here in the last year, I think is mirroring very, very closely what's happening in Europe and the US. Earlier stage deals are still getting done, but at a much smaller volume, at a much longer cadence, slower cadence, with more complexity being built in. So risk averseness.
So more kind of structuring around the deal.
Exactly.
And by early stage, you mean like, up to Series A, so tickets of under 5 million or so.
Yeah, or even up to 20 million, because Series A is obviously in the US and Europe have now become bigger. But yeah, absolutely up to Series A is what I would describe as early stage. Growth deals and Series B deals have dropped off somewhat. And that's also something that's happening globally.
Yeah.
But look, the truism is that good founders with good companies are still going to do well and are still going to find money because there's capital.
Yeah.
There is capital. The question is whether the person who's writing the checks is as gung-ho as they were 2 years ago. So I think really that's the issue. It's not that there's no capital left.
To set the benchmark, let's go back kind of 2 years and kind of compare to where we are today. VCs would come to you looking for, for structuring advice, kind of for drafting, but also due diligence, etc. Maybe could you walk through how that's kind of changed? Like what are, in terms of the robustness of the DD or the negotiation and all of that? Because for us, as like on the investment side, we feel like the founders just tell us like, you've got 2 days to write a check, or whether you either write it or you don't, and that's it. And that always made me feel very uncomfortable. But tell me like how you've seen things kind of evolve on your side.
Yeah. That's an interesting phenomenon because that's the psychological phenomena of the dynamic between founders and investors, right? The FOMO idea.
Yeah.
But look, DD, when I was growing up as a lawyer, DD was all about, and it was usually in M&A or in banking and big value banking transactions. DD was always about, is the price right? Is the deal right? Is there a reason to either walk away from the deal, or is there something that needs to be fixed for us to do this deal in order to mitigate risk? In venture, first of all, early stage companies. If we talk about early stage. Usually there's not that much to DD, right? You're not talking about mature companies. You're usually not talking about huge amounts of revenue. So you're really focused on a few narrow areas of just validating that this isn't going to turn into a disaster. Is the corporate structure right? Is the IP sitting in the right place? That kind of thing. Do the employees have contracts and have they assigned their IP and that type of thing? Now in early stage deals, there is more of a mindset in the investor side of, is this the right deal? Is the price right? Valuation has become something that people focus on. You and I know, if you take SaaS as a vertical, as an example, there used to be this just conventional wisdom that 8 to 12 times top line was the valuation for a SaaS company.
Well, it's becoming like, it became at some point like 50 or 30 or 40, something like that.
Yeah, exactly. I've seen crazy multiples. And now, since the sort of current retrenchment or market that we're in, people are focused on, is it profitable or is it going to be profitable soon, and what's the path there and how do they get there? So I guess due diligence has become a bit more focused on that. But then to the rest of your question around, are these deals becoming more structured and what role is diligence playing? Investors are now trying to get more protection into their investments and being less gung-ho. And one of the things that was a phenomenon in 2020 and 2021 and 2019 is that there were these kind of global investors, not going to name names, but there's a very well-known one that invested in some very big disaster stories. Where they would say, well, here comes the helicopter of this particular investor, and there's somebody in there just throwing checks onto founders. And the problem with that phenomenon is A, it really drives the FOMO. B, it really drives, sorry to say it, but like irrationality in valuation. And so now we're in this market where there's pain. The pain has either started or people know that it's coming.
Well, I think the best theory I heard on like the kind of like I guess you're alluding to, like, I'll say it, like the Tigers, the Cotus, SoftBanks, etc. Is I think that the strategy was not, I mean, people, I think on the outside would see it as that, they were very gung-ho, very kind of loose with their cash, etc. I think what they saw, and I read this somewhere, there was a kind of mismatch at late stage between public valuations. So if you're a public company in SaaS, whatever, you're trading at, let's call it like a 10x multiple or 12x ARR multiple. But then pre-IPO companies that are still growing quickly or faster, that will go IPO in 2-3 years, were trading at like some discount to that. Let's call it 25% discount. So their theory was that, I think, we can grab we can buy the index on all of these companies, and they're at this late stage where they're trading at some multiple to the public companies, and then they're growing anyway. So we'll get the benefit of like multiple expansion. And the company's growing, so we'll make a great return. And let's not worry too much about, these are late stage companies. We will just kind of buy the index, and the index will take care of itself. Somewhat helped by the fact that between 2010 2020, maybe a lot of public companies grew as if they were privately held, especially in tech. So they were growing like 50%, 100% year over year, and their valuations went up and up and up and up. So I think that was the thinking. Where the error was the public market was mispriced, meaning, yes, it was 12x public, and then let's call it, I'm just making up numbers, 12x multiple for ARR for a public company, then 8x for a private company. But then actually, once the interest rate environment shifted, it became like a 3x multiple. And so you're suddenly in private, like, much higher price than what the public is, and you're trading at a premium to public markets, and it's a huge kind of mismatch. It seems like that was what was going on, and now there's this kind of retrenchment around that. Do you think that, though, in terms of looking at more DD, more structuring, etc., is there room for overcorrecting, really, to some degree, just in terms of like the deal terms, on the structuring, on the level of due diligence? Because as you say, the earlier you are, there's not that much. It's a bit of spectrum. Very early, there's not that much to look at except conceptual founder entry valuation. As you go along, there's more and more and more. As the company gets bigger, you get to kind of due diligence more. But are you seeing like investors going overcorrecting to one side, or is this appropriate as in the aggregate?
I mean, it's a good question, and I think it is possible to overcorrect, because at the end of the day, venture capital is an asset class that is supposed to be underpinned by, certain principles and orthodoxies that are kind of connected to that very sort of reductivist but obvious principle that you sit on a kind of risk-reward spectrum, and T-bills are at the bottom left-hand corner, and venture capital is at the top right. Public companies are companies that are open to the world in terms of transparency. And the financial regulators regulate so heavily publicly listed companies or public companies for the sake of protecting the retail investor who might go out and put the house on some company like Apple. So the level of transparency in governments in public markets is super high for that reason. Mm-hmm. In private markets, that isn't there. And so something else that happened in venture, there were a couple of examples. You mentioned Tiger, you mentioned SoftBank. I mean, Tiger, yes, they made loads of those big investments and they were very aggressive. And at one point they were going to just become dominating. But they also had like some really awesome exits. I can't remember the name of that. Is it Juul or the vape company? They made an awesome exit on that. But then you had SoftBank and WeWork, and I think the WeWork debacle was a seminal moment in this, actually.
It's like a premonition. It was the shape of things to come, almost.
100%. And because that company had the arrogance to think that they could go private despite crazy governance weaknesses, then they ended up advertising all of what's wrong in unregulated, private market governance.
They're a poster child for like bad behavior, basically, without it like going into kind of fraud, but almost there, right? The funny thing about WeWork is like everyone signed off on it, basically, like all the board, the shareholders.
Exactly.
So it's just bad behavior. But
it's bad behavior, but with everyone's permission.
Exactly. Yeah, exactly. Because nobody cared enough.
Yeah.
It's just like.
And look, I mean, I'll tell you something. I can say this now that it's 20 years in the past. When I first moved to the region as a lawyer who has this fascination with how people behave and what motivates people and how people get comfort around things. I remember working on one of the first project finance deals in the region. It was many, many billions of dollars. It was a project financed deal somewhere here in the Gulf. I'm not going to name any names. And the banks were like a who's who of the global biggest and best. The French and the German and the British and the American banks, all of them wanted to pile in and bring this debt to finance this project. And the reason that the project is so appealing is that, it's a low energy cost market. So if feedstock is cheap and there's a government entity that's going to guarantee to take all of the product, then it looks like it's a sure thing. Like, how are you going to lose money on this? But the banks, of course, they are publicly listed companies and they have governance and they have shareholders to report to. And so for them, risk mitigation comes down to what happens if the customer defaults. What happens if this value proposition actually ends up failing? And what I saw back in those days, again, now that it's 20 years down the line, I don't mind just being open about this. I wouldn't have said this openly 20 years ago, but, global law firms like the one I worked at the time would say, this structure works and you don't have to worry about that default because there's a local lawyer in that market that says, don't worry, if the government defaults, you'll be able to get your money. And that was wrong. That was actually wrong. And if you were a young lawyer sitting and reading the legislation, you knew that was wrong. But as a lawyer in a global law firm, you weren't the one making that call. Some local lawyer without an insurance policy was saying, it'll be fine. Don't worry, it'll work out. And then the world's biggest publicly listed banks were committing billions of dollars into these deals on the strength of that comfort. So what I took away from that, it's a slightly long story, but what I took away from it is that people with capital have a very interesting psychology around risk. If you think, look, I have to do this deal because I have to be in that market or I have to serve that client or that government. I really want to be, I want to take this risk because there's a great coupon to be made here. Then I'll take a very cavalier attitude to risk, but I'll put all the paperwork in place that makes it look like I did my job.
I'll do a bit of like fig leaf, like window dressing, whatever.
Absolutely. And I saw that happen over and over again. So it really equipped me actually for coming into the venture world, because now I know, in the venture world, we're at the other end of the value spectrum.
Exactly,
But people, one of my lawyers called me one day, one of my associates in my team, she said, listen, Abdullah, I'm doing due diligence on a company and it's a disaster. It's a fintech and it's what it's doing is not legal. And I said to her, okay. And she said, but what do I tell the client? I said, well, you tell the client, first of all, everything that you found. And she said, but that means I'm going to kill the deal. I said, no, you're not going to kill the deal. They're going to invest. I guarantee you they're going to invest. She was like, how? If your background is M&A.
You'll be like,
it's a
non-starter.
But I said to her, look, actually, I'm going to say something controversial now for this purpose of this discussion, is that there's a huge number of fintechs in the Middle East region that are operating illegally.
Well, most, I would say. Actually, majority are in either blatantly illegally operating or effectively in a gray area or unregulated area where if somebody wants to kind of put down the hammer, they could. Right?
Exactly. And funnily enough, in today's little down cycle that we're in, I'm beginning to see financial regulators
like wake
look
up
at things they weren't looking at before.
But I think part of the risk so I want to come back to kind of this idea of like risk and governance and how to kind of manage that at the more macro stage. But something on the VC side is that we look at the way we look at investing as VCs, I think generally is driven by, like you said, like these kind of orthodoxies, like the power law, meaning like you need to invest in 20 companies and then own as much of that as you can, and then one of them is going to succeed, it's going to give you 1,000x, and then and then maybe a couple will return a little bit more, a little bit less, and then the rest are all go to zero. I think there's kind of a chat, and that kind of drives a lot of behaviors around like the FOMO you mentioned. Like, I need to be in this deal because this could be the one that gives me the 1,000x. One complication of doing VC in our market, in the Middle East, and kind of emerging markets more generally, is the power law is not as, it's still there, but it's not as pronounced, meaning we're unlikely to get a 1,000x outcome, or even 100x, or you could get a 100x outcome, but you'd have to invest very early. Because the size of our economies are, if you aggregate the entire Middle East, is reasonably small. Like, we're a $2 trillion economy, not massive. And then our companies tend not to go global. So they are not in the industries or have the abilities yet to kind of really compete to grab, market share in Europe and in Asia and the US, etc. Some exceptions, but generally very hard. So you're sort of investing under the power law orthodoxy, but your upside is capped.
Yeah.
So even if you have the breakout, like think the biggest breakout today are kind of probably Jahiz and Kareem, right? Quite small, like as outcomes, right?
Yeah.
Like, low single digit billions. And this is the absolute best of the best of the best.
Yeah.
And so you will get, I think we'll get like bigger outcomes, but you're not going to get the next, Apple emerge from here. Take an extreme example. So it creates this kind of funny situation where you want to kind of lean into the FOMO, but then if you're rational about it, you say, look, the entire size of the market you cannot have you cannot absorb that type of outcome. So does that mean you have to be much more judicious in how you allocate and much more aware of entry valuation? At least that's some of the thinking we went through, and jury's out whether that was right or wrong. I don't know, but.
Yeah, you're talking about capital allocation, not risk allocation.
Yeah.
Look, absolutely. I mean, I think to think that this market, or even if you took the MENA market or the Gulf market and added it to North Africa and Sub-Saharan Africa and Pakistan and Turkey and all these
adjacent markets.
Adjacent sort of emerging markets. I know that's a very politically incorrect term these days, but
what's the politic term?
I don't know. But I mean, that's definitely how I look at these markets. And I think when you look at those markets, there's a gigantic market. It's much bigger than the US. There's far less penetration of disruptive technology than the US, but the friction of being able to aggregate markets is really
very hard. Yeah.
Whereas if you're sitting in San Jose, you could start up a SaaS company or even a food delivery company or Airbnb, anything, somewhere in California. And then you could be serving 350 million customers in the space of a year because you're in a frictionless giant market.
Yeah.
It's a smaller market than this one, but it's frictionless.
Well, I mean, and with the high purchasing power, I mean, I think people don't understand how wealthy the average American is. Even it's incredible. Like
that's true. But if now this takes me back to my telecom days, something else that really equipped me for being drawn into the venture world. I saw telecom companies like Vodafone, for example, making so much money in Europe. And then I saw them making a lot of money in Kenya and in markets where the average revenue per user, was small, the ARPU, was $3.
Yeah.
Right. The ARPU, that's the unit economics of telco, as you know. And so the ARPU of a $3 in a market like India or a market like any of the low GDP sub-Saharan African markets was still interesting enough because you've got scale. And a lot of those players, and it wasn't just the Europeans and the Americans, it was also the likes of Bharti, Airtel from India, but even Zain Group from the region. I mean, Zain bought a huge...
They bought a lot of licenses everywhere.
Everywhere. They bought Celtel, which gave them 13 operations in sub-Saharan Africa. I mean, all of those were great operations. I mean, how you execute on aggregating economies like that
really hard.
Is fundamental.
And hard, it's tough.
And hard, exactly. And look, as a lawyer, because a lot of the work I've done, particularly during the days of working for telcos, was working for companies that had operations in many, many, many difficult markets. And the way that I approach that in terms of getting comfortable around local law and local risk management was to be quite proactive in understanding the local regulatory and legal environment in each of these places, and then working very hard with local lawyers to innovate and kind of push the envelope without obviously doing what I was describing earlier, which is just saying it'll be fine.
Yeah.
And so, I mean, I worked, for example, with a sovereign wealth fund that had something like 9 operations in sub-Saharan Africa, really difficult countries, not democracies, very poor, very difficult places to do business. But, in doing that kind of work, I was really able with the team I had at the time to help the investor, break down a lot of those barriers, understand the operating environment, and successfully execute on jurisdiction aggregation, for want of a better expression. So I see a parallel for that in the tech space. And so back to your point, I mean, look, if you want to be a Middle East tech company and you just want to focus on the key Middle East markets, which, as you and I know, means UAE, Saudi, and Egypt predominantly. Although I think Iraq is a market that people
is about to emerge.
Ignore it.
Is emerging. It's coming.
Then what you say is absolutely right. And it may be that if you're a venture player in those markets, you shouldn't aspire to be a Sequoia. You should aspire to be somebody who understands these markets and can do well by pitching or by calibrating your valuation expectations and your deal entry around what your exit value is going to look
realistically.
Like. Realistically. But then, the tension that comes into that is with the, this kind of flowing of sovereign wealth into this disruptive tech ecosystem. Because I think that potentially can be unhelpful. Because it drives FOMO, because it drives valuation inflation, because it drives lack of focus on proper execution and governance and structuring and discipline and all of that stuff. So for someone like you, I mean, you told me that my legal practice was ahead of its time. You were ahead of your time because you were one of the very first venture players in the region. You've been around longer than most people. You've probably learned or had more learnings than most people.
I think, the problem with my experience is that a lot of it, or half my career is at the time, I started doing this in 2007 when there was nothing here. And the venture was like, any kind of stuff. Like it doesn't have to be tech, it could be anything. And I think what I may have overlearned is that to be too cautious, because in an environment where nothing was really working and very few things work, so you become overly cautious. So I'm trying to kind of unlearn that, like to be kind of more, a bit more gung-ho, because my kind of DNA is much more, look, like nothing really works, but you need to capture the one diamond in the rough that kind of like works out, and it's very hard to kind of find it, and don't expect it to be huge. And it's something I'm trying to kind of like unlearn in a way, because this is a much better environment for success. I mean, not to take away from my earlier point that I think just it's harder to get like a $10 billion outcome than, almost anywhere else in the world. But you can get a good outcome, much more so today than you could years ago, thanks to, in some way, like what the telcos have done. They built the infrastructure, there's digital connectivity, there's the digital connectivity, there's an economic transformation going on in the region. We're moving away from like statism in some way, shape or form into like much more private sector led, directly or indirectly, whether the governments realize they're doing this or not doing this, I don't know, but they are kind of sparking that in a meaningful way compared to like before. A lot of the regional governments would say it, but not really do it. But now it's like somehow, we're in step one of that kind of move towards private enterprise. So we'll see what happens. But I think on the sovereigns, what's interesting is they are putting a lot of capital when they never did. They never believed in the region at all. And I have a lot to thank for them. I have a business today because like a lot of them are my LPs, and I'm very thankful for that. You do get what I'm cautious about is like, they approach it somewhat developmentally rather than just as allocators. Like they want to kind of build an ecosystem rather than, I think we can make like a 25% return here and we're good. It's not a normal allocation like, I don't know, the Harvard endowment would do to venture, or CalPERS would, or somebody like that. So you tell me more why you're worried about like what the sovereigns are doing here.
It's not. I mean, look, it's not that I'm worried about what they're doing. Most of what they're doing is extremely impactful in a very positive way, I think, because they are building, ecosystems that encourage the emergence of entrepreneurship and innovation and disruption, and that's a great thing. Because if we take a step back culturally in our region, failure has always been so stigmatized that the parents of the region always wanted their children to be doctors and lawyers and engineers and never entrepreneurs. So the fact that that has been turned on its head, and the fact that governments in the region are playing a big role in that culture
is very positive.
It's super positive. I would call it a low-level fear that an overabundance of either patient or not fully financially driven capital, not fully value-driven capital, creates a potentially false market. I'm not saying there is a false market. I'm not saying the whole market is a false market, but there are elements of false market.
Distortionary.
It's a distortionary, exactly.
Effect. Like there's like things that don't look quite like purely natural, as it were.
Exactly. And look, the other thing, coming back to how you allocate funds and the things that you're trying to unlearn. I mean, you and I were talking about somebody before we started recording, a founder that you've invested in, who's doing really well. And I remember him coming to pitch to Dubai Angel Investors for a different company before he set this up. And I remember very clearly him pitching, and I remember very clearly talking to my fellow investment committee members and saying, we should invest in this person, even though this business is going to fail. Because I want to be on this guy's journey, because it's quite a rare thing to find somebody who really gives you a strong sense of how they can ideate, develop, plan, execute, and do it in a really, successful way that differentiates them and enables them to rise. And I think for people like you, and even people like me wearing my Dubai Angels hat, that's all we've got in the region here, because what we don't have yet, and I'm hoping that it will happen, develop, hopefully very, very quickly, is we don't have that kind of science and technology academic environment
like
that churns out your deep tech people and your IP-rich businesses. Maybe it'll happen over time. So all we've got really is that founder differentiation, I think. I mean, I might like that product, but there's going to be 65 products that look exactly the same, and some of them might have been built here, but most of them have probably been built in the US or Europe or Australia or Malaysia, who knows? So the question is whether that person can really execute. I mean, that's 100% the big thing.
I think like it's a bit counterintuitive, and it's repeated a lot, but cannot be underscored enough, which is at the early stage, all that really matters is the person, the founders, because like the idea, especially in our type of markets, like you said, like we don't have these kind of IP differentiators in any meaningful way. And they're not really tech. I mean, we say tech very loosely, right? The definition of what is a tech and not tech company, I think, is not useful. I don't like to think of myself as almost a tech investor, but more like we're investing in founders building kind of new high growth businesses and business models that are interesting. And you want the founders that are able to kind of do that and scale it and make it work, and so to kind of like take it to the.
And one of the challenges we have is like Y Combinator now has their startup school. So anyone who wants to be a founder can learn how to sound and look and act like a good founder.
It looks slick,
So the bullshit radar becomes actually our biggest secret weapon.
And like you get it wrong a lot, because it's easy to kind of portray that, but then once you at the early stage, they're not operating for that long, so there's not much to see except the rhetoric and the presentation and the way they conduct themselves. But then once they start operating, you're like, oh, this is like all show and no go. There's like no substance here. It's just a great pitch and a great way of kind of presenting. And there's not that much to DD anyway, so it's like, oh, we got this way wrong. So it's easy to fall for that trap. I think I'm just like thinking about time, running a bit low on time. But what do you think? What are your kind of major? I mean, just to kind of wrap up on something, what are your kind of major predictions for the next 3-4 years in our ecosystem? In terms across the board, what do you think is coming down the pipe?
So, look, I want to talk about this without sounding too negative. I mean, we are obviously, all of us are in a down cycle at the moment, and so the tendency towards a pessimistic worldview is stronger. But I think we've got some challenges ahead of us in our regional ecosystem because, first of all, we are in our first venture down cycle. We haven't had one in the region.
We didn't have a cycle before.
We didn't have a cycle.
No cycles
exactly,
at all. Yeah.
Exactly. So if you are a fund manager raising funds from LPs, I think there is going to be, if it hasn't already started, a little bit of a movement on the LP side to deploying capital with more mature fund managers, which means external to our ecosystem. But that may or may not be a big problem. I mean, that's something for fund managers to worry about. In terms of my predictions, I think we're going to see quite a lot of challenging situations, distress, in different forms and different degrees of distress. But right now, I'm seeing a lot of companies getting to the end of runway and not able to raise on up valuations. And so the way in which the ecosystem, and it is the ecosystem, there are so many stakeholders in the ecosystem, the way the ecosystem handles those situations with this kind of collective, culture,
down rounds,
or restructurings, or pay to plays, and
I mean, these are really hairy situations,
very
right?
hairy.
Like very difficult for shareholders. Difficult. We've done one just recently. These are kind of like really complex, painful experiences that nobody's used to, because most people are just used to this kind of like everything going in one direction upwards.
So look, I mean, I hate to do a little bit of a shameless self-plug here, but I did the first major, or probably the first down round in the region for a mature venture-backed company, post-Series B, that involved pay-to-play mechanics and very challenging topics like that. And they're challenging because once you've got more than one class of preferred shares, you've got a whole bunch of different groups of people whose permission you need to get to do something that is instinctively against their interest. And so the stakeholder management, the comms challenges, the bringing everybody on that journey and advocating for the outcome is extremely difficult. And we did that deal. It was a successful deal. We won an award for it, actually, because we got a company that was, looking at a sort of almost unicorn valuation. And one of the big names, global names, pulled out at the last minute, and the company hit a wall in terms of cash. We managed to get that deal done. Cash was in the company. The turnaround happened. And that was 4 years ago, actually. It was the first one. It wasn't in a down cycle. It was just that company had bad luck. Now, obviously I've been seeing it happening. First of all, I have 29 live portfolio companies and Dubai angel investors, all of whom have different levels of cash available for their runway. And as a legal advisor, both to investors and to companies, we're seeing these situations a lot. So this year, I mean, I've done definitely more down rounds than I've ever done, and more distress situations than I've ever done. And seeing the way that stakeholders are approaching these worries me a little bit, because on the founder side, I've seen founders who I've thought of as being solid, ethical founders behave in a way which is not solid and unethical, shady, which is very upsetting to see, because as a founder, that's really what you've got to be good at, is fixing or navigating through the most
complex and difficult situations.
Exactly.
I mean, it's not all like clear. I mean, this is the thing. I know it's like a bit of a cliche, but like individuals, you really can understand who they are in challenging situations, right? And now you're starting to see like both funds and fund managers and the founders, you're starting to understand like who they really are, like, how they navigate a difficult situation.
Absolutely. And so that you're absolutely right. The second constituency is the fund managers. So I've seen fund managers playing this kind of posturing game of saying, no, I'm not going to give permission to that deal. I'd rather write it down to zero than give permission for you to do a down round because of the impact it has on me, because I'm not going to participate. And of course, having been around in M&A and private equity and, being known for my approach to negotiations, I've been able to advise clients quite a few times on when I think that posturing is posturing, and knowing that we will get a deal done in the end, but just keeping everybody on side and holding their nerve. But how managers and how investors behave in these situations is just as critical. So there's going to be a lot of that.
Yeah.
But there's opportunity in there.
Yeah.
And, one of my favorite fund managers in this town was a VC in Silicon Valley during one of the sort of post-dot-com, bust periods, where they made a lot of money by spotting special situation opportunities, knowing what a good company looks like, knowing what a resilient founder looks like, and being able to kind of do advocacy well enough that they could persuade an investor that might have to accept 30 or 40 cents in the dollar, or even 10 cents in the dollar to accept it,
rather than zero,
and move on to the next thing rather than zero. And so, that's one of my predictions for the next 3-4 years. The other thing that concerns me in our region is the exit environment. I worry about that a lot. In the US, more than in Europe, but even in Europe to some degree, and even in places like Singapore, you've got the possibility to list and you've got the possibility to go public. We don't really have that in our region. Yes, there's a great stock exchange in Saudi Arabia, and there are going to be exits on the public market in Saudi Arabia, I think, if they can overcome some of their legal challenges and some of their companies' law challenges and some of their civil law challenges. There's friction in those markets. In the market that we're sitting in today, we've got 3 or 4 stock exchanges. It doesn't make sense. There's a real opportunity here.
Arguably the Gulf as a whole. Like with the kind of political considerations aside, it would be such a net positive to consolidate the regional exchanges, right? Like as a whole, not just UAE. But that's like above our pay grade.
It's way above our pay grade, absolutely. But there's there's a challenge in the exit environment, because even in the trade sale environment, yes, you've had breakouts, like you said, Jahez and Kareem and Maktoub and a couple of others that we can name, like Souq, but not many. Not
at the like breakout level. You have like the 50 million, the 80 million, $100 million exit, but like the ones that go north of 300, 400, 500 billion plus, those are, you can count on.
They're rare. And so I am concerned about the exit environment. I think it's something that's going to have to prove itself. My view remains that if you want to be a disruptive tech company coming out of the Middle East, you need to think about how do you develop a playbook for breaking down geographic boundaries.
100%.
And trying to solve the friction. And I think lawyers actually have a big role to play in that. I'm not trying to self-promote, but I think lawyers have a big role to play in that.
Absolutely.
Because that's how you do it. You start consolidating revenue across 16 markets, and there are people who have done it. The telcos have done it.
100%. One last question, I think, around that. Do you feel, one thing that I think about is that there are too many, you feel like in a downturn, as a prediction, that are there maybe too many, they're too numerous, the fund managers, in the sense that what I find unusual about our market, too many small VCs, like way too many, and nobody actually has accumulated large AUM. Nobody really has, even like the brands that have been in the market like years and years and years. Because at some point, it should not fragment. It should like kind of consolidate. Do you see that happening, or do you think it's going to continue the way it is?
Oh, good question. Look, first of all, I would still describe us as a nascent market.
100%.
What are we, 7 or 8 years old?
Nothing,
So do I see consolidation among regional fund managers? I don't see too much of that coming. I do see the potential for global well-known fund managers to consider getting in bed with or acquiring fund managers in the region and kind of bringing the region into their overall stable. Though Sequoia appear to have gone in a different direction by fragmenting regions recently. But I see the potential for that, and I see some really interesting names now deploying a few people to the region to kind of look and see and explore how do we make money here. And I do think there is money to be made if you can do that thing I was describing. But then I don't think we should be too hard on our ecosystem either. If you go to the US, there are some big name fund managers, but then the number of ex-founders or people who have had a good exit that I meet, who now, they had a good exit in, say, an enterprise SaaS vertical serving a particular industry, who say, right, you know what, I'm now going to do a roll-up strategy, and it's going to be deal by deal. and I'm going to go out and identify 16 companies in serving this vertical. I'm going to buy them all, aggregate them, and then list my roll-up vehicle. I see a lot of that. That's all deal-by-deal stuff. So, the big name fund managers, yes, they've accumulated large amounts of AUM, but there are loads of small players, loads. Some of them are corporate backed, some of them are individuals, some of them are want to be venture capital players who are starting to develop a track record. So we're at that super early stage here, I think. So a lot will fall away. Back to your question, I think the ones who don't apply the right kind of disciplines and the right investment orthodoxies will fall away. They'll fail.
There's some I feel like I call it venture tourism, like someone who's usually family office plus they get some money from friends and maybe from some sovereigns, and it's usually the third generation of that family, and this is the cool sexy thing to do. But I wonder if a lot of these guys, when it's not sexy anymore, they're you know what, I could do something else now. I don't know. I mean, I'm guessing, or maybe people find the calling. I don't know.
So you invited me today and said, I want you to be be yourself.
Be yourself.
So I'll say something that's probably not that politically correct. Look, yes, I mean, in the family office ecosystem, a lot of the third generation family members in the big families have taken a particularly strong interest in this space. And have got allocations to go out and invest in venture and venture-backed companies. And some of them have gone down the route of fund of funds, investing with experienced fund managers in the region and out of the region. And some of them have gone down the direct investment route, which I don't think I don't personally think is that smart.
It's wise.
Even if you go out and hire 3 VCs from the US market,
it doesn't
bring
matter.
them in, it doesn't matter. This is a difficult game to make good money in. And you need to be, with venture, you need to be co-investing with other people that bring different takes on the same domain in terms of domain expertise, or different takes on, how do we solve the problem or help this company solve the problem. Doing it in that direct investments way, I think is gonna have bad outcomes for some people. Some people will do really well. But in my opinion, it'll be more fluke than skill. So let's wait and see. Maybe now the enthusiasm is waning a little bit because of the way the current market is going, and there'll be more of a flight to quality, meaning established fund managers with TVPI and DPI stats, up to their armpits, and at that point we'll see less of that activity. But when I talk to a lot of family offices and family businesses, generally when they want to get into this space, I do counsel them to actually go towards experienced fund managers with thematic approaches.
And a thesis, like a concerted thesis or whatever. Great. Well, I think we took up a lot of your time, but this was fun. Thanks, Khaled. Thanks for being our first kind of guest on this.
Not at all. I enjoyed it.
And hope you'll come back and we'll do more of this. And thank you so much.
That'll be great.
Thanks,
Thank you.
Abdullah.
Cheers, Khaled.
All right.